Good evening, investors. Welcome back with me, Madhveshwari, on KleverStock, serving you the latest updates from the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia remained in a negative territory during mid-afternoon trading on Monday, as persistent selling in the financial and consumer sectors dragged the benchmark index lower. As of 3 p.m., the FBM KLCI slipped 2.39 points to 1,737.15, down from Friday's close of 1,739.54. Despite an early gain that saw the index open 1.12 points higher at 1,740.66, profit taking ahead of the extended holiday period quickly erased those gains. The afternoon slump was primarily led by three major heavyweights, which are 99 Sweetmart, Maybank and CIMB, together accounting for 7.17 points of the index's decline. 99 Sweetmart trimmed 24 cent to 3 ringgit 71 cent, while Maybank slid 12 cent to 11 ringgit 94 cent and CIMB dipped 6 cent to 8 ringgit 40 cent. Analysts attributed the heavy selling in 99 Sweetmart to profit-taking following its record 2025 earnings, as the stock saw its busiest trading session in nearly a year, with 32.98 million shares traded by midday. Broader market sentiment turned negative, with losers outpacing gainers 462 to 392, while 544 counters remained unchanged. Total market turnover stood at 1.31 billion shares valued at 1.13 billion ringgit. While the benchmark struggled, select heavyweights provided some support. Tenaga Nasional rose 18 cent to 14 ringgit 14 cent and pressed metal aluminium climbed 9 cent to 7 ringgit 66 cent. Meanwhile, Public Bank managed a marginal gain of 1 cent, trading at 5 ringgit 5 cent. In the broader market, Malaysian Pacific Industries emerged as a top gainer, jumping 52 cent to 30 ringgit 30 cent, while Petronas Gas added 24 cent to reach 18 ringgit 46 cent. Conversely, the top losers included Batu Kawan, which fell 22 cent to 19 ringgit 52 cent, and Alliance Bank, which dropped 20 cent to 5 ringgit 9 cent. The financial services index was the hardest hit sector, while slumping 143.14 points to 21,380.74 as investors recalibrated their portfolios within the banking sector. Market participants expect trading volume to remain thin for the remainder of the shortened week due to the Chinese New Year holidays. Analysts from Kananga Research and Rakuten Trade suggest that the FBM KLCI is likely to remain in a consolidation phase between 1,730 and 1,760 points. Despite the daily dip, the underlying market tone remains constructive, supported by 6 consecutive weeks of foreign fund inflows and resilient domestic demand. Now for some local economic news updates. 99 Sweetmart retail holdings were hard. Shares fell 6.1% to 3 ringgit 70 cent today, despite the companies reporting record-breaking earnings for the 2025 financial year. The stock saw its heaviest trading volume in nearly a year, with 32.98 million shares changing hands after hitting an intraday low of 3 ringgit 66 cent. While the share price retreated, the retailer's market capitalization remained at 33.18 billion ringgit, reflecting a year-to-date gain of 2.1%. The market reaction contrasted sharply with the landmark financial year, where 99 Speedmart surpassed the 10 billion revenue threshold. Total revenue climbed 14.5% to 11.43 billion ringgit, which core net profit jumped 20% to 614.2 million ringgit. This growth was fueled by 259 new store openings, bringing the group's total network to 3,037 outlets by December 31, 2025. Same-store sales growth remained healthy at 7.8%, supported by 532 million total transactions, with an average basket size of 21 ringgit 50 cent. The company's bulk sales e-commerce platform also demonstrated significant momentum, with revenue surging 214.8% to 72.8 million ringgit. RHB Research maintained its neutral call on the stock, slightly adjusting its target price to 4 ringgit 2 cent from 4 ringgit 6 cent. Analysts noted that while results met expectations, much of the positive sentiment, including the benefits from the government's SARA initiative, may already be reflected in the current valuation. Looking towards 2026, 99 Mart intends to maintain its aggressive expansion target of 250 new outlets annually. The retailer is also set to benefit from the expansion of the government's Sumbangan Asas Rama Sara credit program, with more than 2,000 outlets already participating. Beyond domestic growth, the company is eyeing international market, having already established a retail presence in Fuzhou, China, to diversify its addressable market and sourcing options. Founder and CEO Lee Thiam Wah emphasized that financial year 2025 was a pivotal year for the group, successfully achieving its 3,000 store target while maintaining its near and safe ethos. RHB Research highlighted that long-term sustainability will be anchored by these expansion efforts and innovative retail programs designed to capture resilient consumer spending. As the group scales in bulk sales platform and tests regional markets, it remains a key beneficiary of government fiscal support and domestic demand for daily essentials. Still on economic news, Investment Bank have revised their 2026 GDP forecast for Malaysia upward to a range of 4.5% to 4.7%. Kenanga Investment Bank maintained its forecast at 4.5%, noting that if current momentum persists, growth could reach 5.0%. This trajectory is anchored by resilient domestic demand, supported by a firm labour market and rising household incomes. Major policy frameworks, including the new Industrial Master Plan 2030 and the National Semiconductor Strategy, are expected to sustain robust investment levels through 2026. Apex Securities and Hong Leong Investment Bank both raised their projections to 4.7%, citing the strong momentum established in late 2025. HLIV identified domestic demand as the primary growth engine, while Apex Securities emphasized the spillover effects of data center expansions into high-value ICT services. Analysts noted that investments led by ongoing data center expansion are expected to generate positive spillovers into higher value-added activities, reinforcing the country's shift toward more complex economic sectors. The services sector is set for a significant boost from Visit Malaysia 2026, which targets 47 million international arrivals and 329 billion ringgit in receipts. Kenanga highlighted that tourism will provide a strong uplift as capacity ramps up under the national campaign. Supportive government policies, including targeted aid and income-enhancing measures, are also expected to keep private consumption stable despite potential global trade uncertainties and protectionist trends. On the monetary front, Bank Negara Malaysia is widely expected to hold the overnight policy rate steady at 2.75% throughout the year. Analysts believe this neutral stance remains appropriate to support economic growth while maintaining price stability. While external risks like weaker global demand persist, the bank's current policy is seen as supportive and economy amid price stability, providing a predictable environment for long-term project execution. Malaysia's 2026 outlook remains cautiously optimistic, while growth balanced between internal spending and external trade. HLIB also remarked that upside factors include an easing in global policy uncertainty and stronger than expected demand for electrical and electronics goods. With the implementation of the 13th Malaysia Plan also beginning in 2026, the nation is positioned to transition from reform to long-term transformation across its high-growth, high-value industries. Up next, we have some corporate updates. MISC Group, via its joint venture Vietnam offshore floating terminal Ruby Wharf, has secured a contract expansion with Petro Vietnam for the FPSO Ruby 2. The agreement covers the lease operation and maintenance of the vessel until December 31st, 2027. Operation in Block 01 and 02 offshore Vietnam since June 2010, the FPSO Ruby 2 is an Aframax-sized unit with a production capacity of 39,000 barrels of oil per day. The Wharf joint venture is 40% owned by MISC, with Petro Vietnam Technical Services Corporation holding the remaining 60%. As MISC's first offshore asset in Vietnam, the vessel has been foundation in building the group's regional presence and its partnership with Petro Vietnam. The extension ensures the continued performance of a key asset that has been operational for over 15 years. MISC President and Group CEO Zahid Osman stated that the contract aligns with MISC's disciplined asset management strategy to secure stable cash flows from existing assets. He emphasized that the deal reflects a commitment to creating long-term value through safe, reliable, and responsible operations. The extension allows MISC to maximize the life cycle of the Ruby 2 while maintaining a steady stream of recurring revenue. The continued operation of the Ruby 2 is vital for the Ruby fuel's production targets through the 2027. By maintaining its 40% stake in the asset, MISC reinforces its status as a reliable technical partner in the Southeast Asian energy sector. The deal highlights the group's ability to retain long-term contracts for its established offshore infrastructure. With its extension, MISC secures operational visibility for its offshore segment for the next 2 years. The group also remains focused on high-value asset management and fostering deep-rooted regional partnership. The FPSO Ruby 2 continues to serve as a reliable contributor to the group's offshore portfolio and Vietnam's energy production. And finally, wrapping it up with the latest local updates, CIMB Group Holdings Berhad is facing a potential divestment of up to 7.4% of its stake in PT Bank CIMB Niaga Tbk to comply with proposed Indonesia Stock Exchange regulations. The ID Act is reportedly moving to double the minimum free float requirement from 7.5% to 15% across the bourse. This shift follows concerns from MISC Inc. regarding the market's investability and transparency, with a final resolution expected by May 2026. CIMB currently maintains a 92.4% stake in its Indonesian subsidiary. According to Hong Leong Investment Bank Research, divestment is the most likely strategy for the bank to bridge the 7.4% gap. Based on CIMB Niaga's current market capitalization of 46.8 trillion rupiah, approximately 10.9 billion ringgit, such a sale could generate 810 million ringgit in one-off proceeds. Despite the Indonesian unit's significant role, it historically contributes 25% to group pre-tax profit, and the impact of the stake reduction is projected to be marginal, trimming earnings by just 1.2% in 2026 and 2.0% in 2027. The anticipated 810 million ringgit in proceeds is expected to be redeployed to enhance shareholder value. HLIB noted that the group may leverage these proceeds for loan book expansion or potentially distribute them as a special dividend. If a special payout occurs, it would supplement CIMB's existing 2 billion ringgit capital return plan through 2027. This could raise the bank's dividend payout ratio to 70% and lift its projected dividend yield to approximately 6.5% for the 2026 to 2027 period. On the risk front, HLIB highlighted that while the Indonesian rupiah remains volatile, the overall impact on CIMB is manageable. Every 1% depreciation of the rupiah against the ringgit is estimated to shave only 0.3% of the group's pre-tax profit. HLIB maintained its buy call on CIMB with an unchanged target price of 9 ringgit 50 cent, viewing the potential regulatory-driven sale as a tactical opportunity to optimize capital while maintaining a robust balance sheet and a clear majority interest of 85%. The divestment could serve to deepen CIMB Niaga's liquidity in the Indonesian market, potentially attracting more institutional investors. As the May 2026 reassessment by MSCI approaches the group's ability to navigate these regulatory shifts while sustaining high shareholder returns remain a key focus. Other major Malaysian players with Indonesian exposure, such as Maybank, are also closely monitoring these developments, and the IDX aims for broader market reform to preserve its emerging market status. Well, that's a wrap for closing bell updates with me, Madhaveshwari. Thank you, investors. We shall catch up in the next session. Goodbye.